European measures. In response to ongoing economic weakness, the European Central Bank introduced a range of unconventional monetary policies. One of the key actions was the implementation of large-scale bond buying programs, similar to quantitative easing used in other parts of the world. In addition to this, Europe introduced negative interest rates. This meant that commercial banks were charged for holding excess reserves at the central bank, which encouraged them to lend more money instead of keeping it idle. These measures were designed to stimulate economic growth, increase inflation, and support stability within the Eurozone, especially in countries that were hit hardest by the crisis. Japan adopted a unique and long-term approach to monetary policy. It introduced quantitative and qualitative easing, also known as QQE, which combined large-scale asset purchases with additional policy tools. One of the most distinctive strategies was yield curve control. This allowed the central bank to directly manage interest rates across different maturities of government bonds, ensuring they remained low. Japan also faces extremely high levels of government debt, making these policies even more important. The overall goal has been to maintain economic stability, support growth, and avoid deflation over the long term. Practical meaning. In practical terms, these policies involve central banks exchanging bonds for reserves. Financial institutions sell bonds to central banks and receive newly created money in return. This process significantly expands the balance sheets of central banks and increases the amount of liquidity in the financial system. At the same time, it pushes interest rates lower across the economy. Lower interest rates make borrowing cheaper, encourage spending and investment, and support asset prices. However, while these effects can stimulate growth, they also introduce long-term risks that need to be carefully managed.